good afternoon to all of you who've joined us here at 14th Avenue, our home here at MTN, and those who are joining us on the various media platforms, and to the MTNers who have delivered the results that Sulu and I have the pleasure to share with the broader investment community, media, as well as broader stakeholders. I trust you've had an opportunity to work through the SENS. It's quite a detailed document, quite a lot of financial analysis there, as well as the annual financial statements. And I wanted to start off by talking to you about the 5 key messages that are embedded within our financial results. The first is that we've had excellent commercial performance, which has been led by MTN Nigeria and Ghana. There's been broader performance coming through some of the OpCos. We've seen a really good turnaround in a market like Zambia, strong results coming into Cameroon. So a very strong commercial performance driven by us focusing on driving leading customer experience. Today you've got to fight for the customer, and supported by material investments that we've made into our network, close on to 38 billion rand ex leases is the amount of capex we've put into our networks. And so the commercial performance has been excellent, as I mentioned earlier. We've had a relatively benign macro in the last 12 months. We saw currencies quite stable and actually strengthen in some regard, particularly the cedi. The Naira also pulled back from the very high devaluation levels it was at. And we saw inflation start to moderate across markets. So the underlying strong commercial performance translated into very strong financial results, as Tsulu will share. Strong earnings, strong free cash flow, and returns above our own guidance. The third message is really around shareholder remuneration. And starting with last year's dividend, the board has declared 500 cents per share as dividend. We had indicated in our open policy framework for dividends of 2025 and before that we would do a minimum of 370 cents. So through the strong cash generation that we've been able to deliver, we're pleased that we're able to declare the 500 cents. So that's 45% above the prior dividend of 345 cents. We are also announcing with the results and the SENS an enhanced shareholder remuneration framework that encompasses both cash dividends and share buyback, and I'll come back to that a little bit later. Number 4, we now at the end, as the end of 2025, we came to the end of Ambition 2025. We're looking to the next 5 years and are announcing that we are pivoting to Ambition 2030, which is essentially streamlining the execution that we had, but fundamentally still the same strategy that is driven by an investment case that says there is a significant digital and financial inclusion opportunity across our markets. And the fifth is that we are reaffirming our medium-term guidance. We've made tweaks to the return metric as well as to leverage metrics, which I'll come to a little bit later. So in terms of commercial momentum, we crossed over the 300 million subscriber mark. We ended the year just over 307 million subscribers across our market, seeing very strong net additions, particularly in the second half of the year. So H2 much stronger than H1. And so we saw that growth in not only subscribers, but also active data subscribers. This is the data era, and we're seeing data subscriber growth. So coming back to subscribers, we pretty much were adding in the last 5 years 10 million subscribers per year. That's been very pleasing for us to see that growth being sustained. And you can see there in the data traffic, which gives you a sense of the demand for our solution, that's grown at about 27%, 24.7 petabytes of data that have come through in our network in 2025. On the fintech side, again, strong growth that we've seen. Monthly active users just shy of 70 million. But I think it's quite impressive how much of the transaction value that is moving through that platform. $500 billion of transaction value. And when you look at it on a constant currency basis, just under 38%. Reported basis is more like 55%. So a lot of transaction that is going through the MTN network at the moment. So very strong commercial performance we've seen in 2025. As I mentioned, that translated into very strong financial results. And if I start with service revenue, and Tulu will break down the service revenue bearers a little later, the 22.7% constant currency service revenue growth is the best that we've had since 2008. So it's been a long time coming to see the level of growth in a constant currency at those pleasing levels, and materially well above our own guidance, and also well above inflation. Inflation across our markets was more around the order of about 13% on a blended basis. So, almost 10% headroom of service revenue delivered against the blended inflation in our markets. Just focusing on the return metric, as I mentioned, earnings very strong, adjusted headline earnings per share above 67%. You see it there on the screen at 13.59 cents per share. And then operating free cash flow also coming on strong, showing growth of almost 82%. And as I mentioned, our return metric, which we've used up to 2025, above our guidance of 25%. So very pleasing to see that. And as I mentioned, the dividend declared, which will be paid in April, is 500 cents per share. Talking about the enhanced shareholder framework, which has been some time a work in progress. We did communicate in 2024 when we had the challenges in Nigeria of a rapidly devaluing naira and escalating inflation, and the impact that had on our leases, and we went into negative equity. We set forward our 5-point plan, and at that stage we had conversations with the investment community that at the point in time that we had restored distributable reserves in Nigeria, and secondly that we were confident that we're able to procure dollars for dividend repatriation, we would come back to the market with an enhanced shareholder framework, which is what we announced with our results. And this medium-term shareholder remuneration framework has a couple of elements that I hope I can describe them super clearly to yourselves. The first is that we're looking at an annual distribution of 40 to 60% of equity-free cash flow as shareholder remuneration. Within that construct, we're going to have a minimum cash dividend of 40% of that equity-free cash flow. We will look to a further 20%, which could be as cash dividends or as part of a buyback program. In terms of that buyback program, the board has approved a buyback program over a 3-year period of 6 billion rand, which we will look opportunistically to acquire our shares and permanently cancel those shares. And if you look at where our share price is today, and you look at the shares outstanding, that's approximately like 1.7, for those who want to round up 2% of outstanding shares that would look with that program. And obviously, once we complete, we can have a relook of whether we want to further, increase that program. And obviously, we want to execute all of this within our capital allocation framework, which we've further simplified to have 4 pillars, which I'll talk to a little bit later. Just moving to the operational results, let me start off with South Africa. And I wanted to start off with the market context of South Africa. I think there are 3 points in market context that I would like to highlight. I think the South African consumer in SA has been in an okay shape. Let's not say the South African consumer is in a great shape or a bad shape. Let's just say okay. But the consumer behavior that we've been seeing is that actually there's a lot of disposable income that's now going on to areas such as online gambling or gaming, if you want to call it that. And we think that this is probably a structural change, and we're seeing it across several markets where this is becoming kind of more prevalent. So it isn't a once-off, it's actually structural. As I said, the SA consumer has not been in bad shape, but the competitive intensity that we've seen in the prepaid market which we spoke about last year, we saw it continuing into the final couple of quarters of 2025. So the story of MTN SA is one of two sides. There's firstly the SA prepaid, where it's under pressure. We saw service revenue there degrowth of 4.4%. It makes up 52% of service revenue. So when you have degrowth there, you've got to climb quite a bit to end up at 2% service revenue, because the consumer postpaid business and enterprise all have grown pretty strongly. So that's a market where we said with our H1 results in August that we foresaw a couple of quarters where the initiatives that we want to bring in, mostly at a commercial level, sales and distribution, will take us a couple of quarters before we start to see green shoots or getting back into growth. And I think you can anticipate that Q1 and Q2 will still be difficult for MTN SA as those initiatives start to gain traction. And Ferdy, Yolanda, Dineo, and the broader team have their eyes very fixed on ensuring that we do see this prepaid recovery. As I mentioned, postpaid, enterprise, wholesale pretty much where we expected it to be. The pressure is on prepaid, and therefore it's a focus for us. We did put in sufficient capex, just under 7 billion of capex, order of magnitude 13% capex to sales, which is in line with peers. And the network, has had some investment, so we thought that level of investment is sufficient to maintain a high-quality network. So those are the key points I'd like to make around South Africa. Coming to Nigeria, Nigeria released results a couple of weeks ago, and many of you have digested those results, and fantastic set of results. And again, starting with the macro, a couple of key call-outs. I think the first is the tariff increase that came at the back end of Q1. We started to see it flow through into Q2 results and so forth. Inflation started to moderate. More broadly, the Naira was a lot more stable. In fact, it did appreciate against the dollar. Oil prices, were in the 60s. And we'd also renegotiated the IHS contract at that time. And all those benefits from that 5-point plan flowed through, supported by commercial execution, to deliver the stellar results that Nigeria, put 55% service revenue growth, very strong growth in terms of data, and free cash flow generation has been very strong. We put a lot of capex into the network. We had committed to the authorities that would also be dealing with quality of service issues. The quid pro quo to get the tariff increase was to ensure that Nigerian consumers are experiencing high-quality data networks. So our focus, you'll see that the capex intensity in Nigeria is at the top end of the range, closer to like 19%. A lot of that was to deal with the QoS in several clusters, Abuja and other areas where we had picked up that there was improvement needed around the quality of service, quality of experience. But very pleasing results, coming out of Nigeria. Just talking to markets more broadly, again, as I mentioned, this is a broad-based set of delivery from across the markets. SIA, which a big part of SIA is Uganda. You can see that the subscriber growth close on to 10%. Again, very strong Q3 and Q4 coming through. Good growth in active data subscribers, as well as on our mobile money platforms, our fintech platforms, and similar dynamic that we see, Weka, growth there in Weka. A little bit of pressure, particularly in Cote d'Ivoire. But Cote d'Ivoire for us has now become a business where we're starting to see the connectivity business improve. Still some challenges on the fintech business, but overall, the Weka results, which also have embedded in them the Ghana results, coming out pretty strong. Talking about fintech, as I mentioned, good growth, close on to 70 million monthly active users. You have a transaction value that's close to 500 billion. What has been pleasing is that the advanced services continue to grow quite rapidly at 40.5% service revenue growth. We've always said that the future of this business is going to be the advanced services. The basic services, yes, they remain important, but if you look 3 to 5 years out, you have to have a strong base of the advanced services, payments and e-commerce, bank tech, and so forth, remittance. Those are the services that will stand us in good stead to sustain a good investment story for the fintech business. Creating shared value has always been a key pillar and a differentiator for MTN. The way we express it and measure it is around our eco-responsibility, which is mainly around the role of reducing greenhouse emissions, sustainable societies, broadband coverage, as well as having diversity. There we're targeting women in the workforce and good governance. On eco-responsibility, good progress on Scope 1, Scope 2. So, quite strong performance in terms of greenhouse gas reduction. Part of that growth that you see as 48% is some SA emissions that have moved into Scope 3. All our measures are on a Scope 1 and Scope 2 basis, but overall seeing good growth there. Broadband coverage just a smidgen off our target of 95. We did decelerate rural connectivity in Nigeria in 2024 and a little bit of 2025. We'll really catch up. That's the real delta there in terms of the 94 versus the 95. So pretty much there. And good progress around diversity and inclusion. Some of you will well remember when the 45 at the beginning of the strategy was 39. So pretty much adding 1 percentage point every year into the workforce in terms of women representation. And we're still maintaining our target to 2030 of 50%. So we're making good progress. There's always narrative around the cost of data. And I guess it'll always be, that narrative will be permanently with us. But when you look at effective rate per gigabyte, that's actually come down just over 14% on a blended base across our markets. So giving a lot more value to our customers as well. Just against the guidance, before I hand over to Tsulu, we're pretty pleased with the delivery against guidance as of the end of last year. As I mentioned, SA, we're at the bottom end of our guidance range. That's why we have it as amber. Fintech, advanced services growing strongly, and but the basic services were a little bit lower, so we marked ourselves there amber. On asset realization, amber, because we didn't hit the 25, but I think there's good rationale for not hitting the 25. Two big asset realizations were in the original targets. The one was selling Nigerian further down. There was another 11% still to go. So we didn't do that for good reason that we communicated last year. And then obviously IHS, we have had a strategic repivot on IHS. So if you take those out, I think on the asset realization, a job well done by the teams that are focused on that. So with this, let me pass on to Tsulu, and I'll be back to talk to you about strategy and outlook.
Good afternoon, everyone. Joining us for this pleasing set of results. We are very pleased to present a very strong financial set of results for the full year 2025. And I think before I do that, I just want to take you through some of the key messages that are coming out of these financial results, and I'll unpack, the themes as I walk you through the presentation. I think the first point to make here for us is that we've seen a very sustained momentum across all the key financial metrics for 2025, and this was really reflected in the strong top-line growth, margin expansion, and a broad-based improvement across our financial KPIs. We saw further improvement in the quality of our earnings, also supported by a more stable macroeconomic environment in several of our key markets. The second point here is that we kept a very strong focus on our expense efficiency program, and this resulted in a delivery of 3.6 billion in the year, exceeding the target that we had set for ourselves, demonstrating the ongoing structural benefits that have come with the program. Thirdly, I think as you can see, our free cash flow generation has strengthened materially during the year, And I will unpack this later, but in short, it also reflects the improved profitability as well as tighter working capital management and a continued focus on our cash discipline across the group. The fourth highlight here, as Ralph indicated, is really on our return on equity, which surpassed our medium target of 25%, reaching 25.6%. And finally, we sustained the healthy balance sheet and financial flexibility that remains central to our operational resilience and our strategic execution. I think with that context, then, let me just take you through the salient points, firstly, in terms of the summary of our group financial P&L. To call out just a few on this slide here, as you can see, group service revenue on a reported basis grew 22.9%, reaching 218.5 billion rand. And in constant currency, we saw a similar trend at 22.7%, which was firmly ahead of our medium-term guidance as well. And this really underscores the robust top-line performance across our African footprint. Reported EBITDA increased by 64% on a reported basis, with pleasing growth of 36.8% in constant currency. And this really reflected the strong revenue momentum as well, as we continued with our margin expansion, achieved also through disciplined cost management. In constant currency, our EBITDA margin improved to 44.5%, which was a 5.4 percentage improvement. And this really translated into a meaningful earnings before interest and tax, which more than doubled year on year. And this reflected also an improvement across. And I think from a constant currency perspective, from an EBIT perspective, we achieved 61%. Below the line, you will notice that our finance cost declined by about 53%, reflecting firstly prudent balance sheet management and lower FX impacts that we saw particularly in Nigeria, where we saw the stability of the Naira during the year against the dollar. There were also gains from the appreciation of the Ghana cedi in the year. And the underlying finance charges, therefore, excluding FX impact, grew by 6.7% year on year. The tax expenses were up by about just over 190%, and this was mainly reflecting our much improved profitability, but there were also impacts from a non-deductible expense perspective and some unrecognized deferred tax assets in the main. Non-controlling interest, as you can see, also a significant improvement due to the recovery mainly of MTN Nigeria. And then at the bottom line, you see attributable profit increasing to 20.3 billion, reinforcing the recovery in the earnings and the profitability across the group. And I mentioned the return on equity as well, where we saw an improvement year on year of 6.9% to 25.6%. Now, if I move on to the next slide here, just very important to show the pleasing sequential progression that we saw in our financial key metrics as we progressed into the second half of the year. I think just to call out a few KPIs here very briefly, you'll see our service revenue accelerating to 23% in the second half from 22.4% in the first half. And then EBITDA increase in the second half, with margins remaining robust, supported by ongoing cost discipline that I mentioned earlier. And then in terms of leverage, you'll see that the consolidated net debt to EBITDA improved further to 0.3 times by the year end, while holdco leverage reduced to 1.3 times by the year end, both comfortably within our targeted thresholds. This was also supported by very strong cash generation and upstreaming from the OpCos, which accelerated from 8.2 in the first half to 9.2 billion in the second half, totaling 17.4 billion for the full year. Now, if I can turn briefly to our two large markets, starting with South Africa. Overall, as indicated, we saw service revenue increase of 2%, largely supported by the growth in data wholesale as well as enterprise related. And this comes at the back of a highly competitive environment in the market, particularly in prepaid. Data revenue grew by 4.5% year on year, while voice declined by 4.2%, which was really consistent with the competitive pressures that I mentioned in the South Africa voice market, especially on prepaid. And again, as Ralph indicated, there's plans in place to make sure that we turn this around. But as we always say, it's not a quick fix. These things take time, but the team is well underway to make sure that we make the right progress here. Within the other service revenue bucket, you can see that we saw an increase of 3.1%, and this includes wholesale revenue that grew by 2.5%, as well as enterprise ICT and bulk SMS growing by 8.5%. Enterprise on its own grew quite significantly by just over 13%. EBITDA declined by approximately 10% here, with margins reducing from 37.4% to 34.6%. And this was impacted by higher share-based payments due to the share price movements on the staff cost as a line. Excluding these, EBITDA margin would have been around 35.8%, and OPEX increase of just over 4% year on year. But I must say that MTN SA did a very good job in terms of keeping the expense growth in check, and I will share that later on as I talk about our group expenses. In terms of capital expenditure, MTN South Africa spent about 6.8 billion rand during the year, with capex intensity of 13.4%, and the reduction is following the conclusion of the network resilience program that we had back in 2024. So for the OPCO, for SA, the OPCO continues to implement the initiatives that are needed, as I indicated, to get back on track. If I can move on to MTN Nigeria briefly, most of you will have seen the results. Safe to say that we've seen a very strong set of results from Nigeria, with service revenue up 74%, data growing by 74%, and voice also performing strongly, growing by 42%. Alongside operational execution, you'd recall the phased pricing revisions that were implemented during the year, and which provided a meaningful boost to service revenue growth. And most of these benefits came through in the second half of the year. And then on the back of the top line growth, we saw EBITDA margin more than doubling as well, over 100% increase. And as a result, we saw an EBITDA margin expansion of 13.6 percentage point to almost 53%. And in terms of capital expenditure, MTN accelerated investments to 11.9 billion during the year. You'd recall that last year they had reduced, in 2024, they had reduced capex by almost 53% due to the macroeconomic environment. So we're really delighted with the turnaround we're seeing in Nigeria, particularly with the resumption of the dividend and the cash upstreaming to group. If I can just briefly touch on the fintech business as well, I think, sorry, I went right. Yeah, so just turning on to the fintech business briefly, we saw service revenue increase by 23.2% in 2025, with advanced services around 40%. And this aligns with our strategy to grow the segment faster, which has increased its contribution overall of total fintech revenue to now 29% from 25% last year. And this really supports the stickiness and overall quality of our ecosystem, including the benefits of profitability and the cash flow that we see. So in that regard, we've seen also EBITDA margin improvement in fintech of 2.1 percentage points to 42.8%. I just want to touch briefly on the rest of the markets portfolio, which I think is important. You will see that we're still reporting, in terms of SIA and WECA, and as we have communicated, going forward, we'll be reporting in terms of Francophone and SIA Ghana and as well as the rest of the southeastern African regions. So in terms of the broader markets, I think the key call out here is to indicate that both SIA as well as WECA grew their service revenue above inflation and also saw a margin expansion. You will notice that SIA service revenue increased by 21% against blended inflation for the region of 12%, driven by strong growth in data as well as fintech. And then the EBITDA margin growing to 47.5%. And within the portfolio, we've got MTN Uganda that grew service revenue at around 13.5 percentage points to 17.7 billion, and with margin improvement of 1.6 percentage points. When we move to WECA, you'll see that they also grew service revenue by 18.5%. Versus blended inflation of 8.9%. MTN Ghana, once again, within the WECA region, led the performance with growth in service revenue of 35.9% and a margin of improvement of 3.2%, reaching 60% EBITDA margin overall. So it is fair to say that overall the markets portfolio also produced brilliant results. And I think it's also worth mentioning some of the markets within our portfolios where we've seen an improvement. For instance, we've seen great, strong results coming from Cameroon, Cote d'Ivoire on the connectivity side, Sudan, South Sudan, Zambia, as well as Rwanda, where these OPCOs have shown a pleasing turnaround and trajectories in their financial performance. Just moving on to the group expenses, which were well managed again during the financial year, well below our blended inflation environment. As you can see, we saw total group expenses growing by 9.3%. And looking at the composition of the expenses, you'll see that cost of sales increased by 4.5%. And this reflects in part the lower device cost of sales, particularly in South Africa, as the business continued to optimize their device strategies as well as reduce the exposure to lower margin revenues. Operating expenditure increased by 13%, which was also slightly below blended inflation, driven mainly by employee expenses, largely due to increase in the share-based payments as a result of the share price appreciation. We also saw an increase on the network-related cost as we continue to invest in network quality as well as capacity. But I think importantly, as I indicated, these are also below blended inflation overall. We also delivered, as I said, 3.6 billion rand in savings during the year, taking our cumulative achievement to 7.4 billion rand over the 3-year period since we started on EEP 2.0 in 2024. So this is really reflected in our total cost to revenue ratio, which improved from 61% in 2024 to now 55.6% in this financial year. And the majority of the savings, approximately 64% of those, particularly came from network and IT, as we continue to drive our focus on structural efficiencies. And we also saw, by market perspective, a significant contribution coming from Nigeria, largely due to the lease renewals, and as I indicated, a portion coming from MTN South Africa as well. Just to move on to our earnings per share, and if I can walk you through the reconciliation to adjusted headline earnings per share. Starting at the top, you'll see that our attributable earnings per share improved meaningfully in the year 2025, reflecting the strong recovery in operating performance, particularly in Nigeria, alongside a more stable macro environment relative to the prior year. Reported attributable earnings for the year, earnings per share for the year was 11.13 cents, compared to a loss position in the previous financial year. The most significant adjustment here related to impairment charges, primarily associated with goodwill, property, plant and equipment and associates, which amounted to 157 cents per share in this year. You would have seen from the MTN Ghana results as well, and associated group announcement at the time the effects of an IFRS 16 adjustment relating to the prior year for the group. This related to 12 cents per share, and it was largely due to the hyperinflationary impacts that rolled it up to group. After adjusting for impairments and other disposal-related items, basic headline earnings per share increased by 12.74 cents, representing a very strong year-on-year improvement. However, you'll see that our headline earnings per share was still impacted by some non-operational items, and therefore, as we adjust for these, we saw an increase to 13.59 cents per share on our adjusted headline earnings per share, which was really an increase of 67%. Just briefly on our capital expenditure, our business continues to grow, so it's important that we continue to invest for growth. We spent 38.5 billion, translating to a capex intensity of 17%. The increase in capex was primarily driven by the accelerated network deployment that mainly came from Nigeria, as the business accelerated investment this year, as I mentioned earlier, in addition to Ghana as well, particularly also bolstered by the stronger Ghana cedi against the rand. From a geographic perspective, the majority of the investment was directed towards the broader markets, with SIA and WECA making up a total of 47% together in terms of total to group spend, and the balance of that coming from Nigeria, which was 31%. And by category, the major capex deployment, as I indicated, was coming from our networks, and 25% of that coming from IT systems in the main. Moving on to the free cash flow, let me now just turn into how we have fared, and this is the most pleasing results as well relative to historical trend. In 2025, you will notice that operating free cash flow before spectrum and license payments increased by almost 82% to 57 billion rand, underpinned by a significant improvement in EBITDA, disciplined working capital management, and a continued focus on our cash generation across the group. This improvement in our free cash flow generation was also delivered against a tick-up in our capital investment, which I mentioned previously. In the second half of the year, we also accelerated some efforts in terms of working capital management, where we improved data collection across our markets and continue to optimize on our inventory and payables. And in South Africa specifically, we advanced our cash release initiatives, including the ongoing handsets receivables financing, as well as supply chain financing initiatives. After accounting for spectrum and licenses, as well as interest and taxes, we saw a consolidated free cash flow for the group up to 26.9 billion, almost 27 billion rand. This was an increase of more than 4 times relative to the previous year. As Ralph noted earlier on about the enhanced shareholder remuneration framework, which will really be based on our equity free cash flow, we paid about 5.3 billion rand in dividends to non-controlling interest, but this also included a 2.5 billion rand wind-up dividend relating to Zakhele Futhi, and this resulted in our equity free cash flow growth of about just over 380% to around 22 billion rand. So on the whole, this represents very strong recovery in terms of cash generation compared to the prior year, and really provides us with a solid foundation in terms of deleveraging our dividends and ongoing investment for growth. Now talking to the next slide, which is really around our leverage and liquidity profile. It's important to highlight, as we've said earlier on, that we have been really focused around balance sheet management, and you can see that we've seen a consolidated net debt to EBITDA to improving to 0.3 times now from 0.7 times same period last year, and this reflects strong recovery in EBITDA, improved cash generation, and disciplined balance sheet management, as I indicated. At the holding company level, our holdco leverage is now at 1.3 times, which is below our guided 1.5 times that we've guided to the market, and even our group leverage is way below our covenant limits. In terms of currency mix, our non-ZAR debt at holdco level stood at approximately 16%, once again, which is well below our medium-term threshold of 40% for the foreign currency denominated borrowings. Cash upstreaming, as I indicated, 17.4 billion rand as well, supported the improved leverage at holdco, but also our liquidity headroom, which now increased to 43 billion rand, with closing cash balances of 20 billion for the year. Turning to the right-hand side of the slide, the maturity profile of our debt at holdco is now well staggered over the next years, helping us to mitigate the refinancing risk. Our immediate focus here is also continue to refinance the maturities that are coming through in 2026. We manage our debt profile very proactively and continue to benefit strong access to and support from the debt markets. And really thank you to some of our lenders for the partnerships that we've had over the years. So we are very comfortable with where we are from a balance sheet perspective. Lastly, before I hand over to Ralph, I think it is important to just highlight in terms of where we are following our Ambition 2020, and as we move into 2030, which Ralph will take you through. I think to summarize, we're really encouraged to see the pleasing set of results, firstly for 2025. We've delivered sustained momentum broadly across all the elements of our key financial KPIs and earnings, very good quality earnings, as well as attractive free cash flow generation and a healthy financial profile from a balance sheet perspective. We've had a framework that always aimed at looking at service revenue above inflation, so growing our in real terms, and what we had from a medium-term guidance perspective was growth in high teens with improved margins and earnings and a disciplined capital allocation approach, really focusing on attracting free cash flows, driving attractive free cash flows, as well as reduced leverage. And I think as we can see these numbers here, suffice to say that our service revenue growth has grown at almost 17%, which over the years is above our blended average of about 14%. Had we not done all the EEP initiatives that we've done, given the shocks that we've had, we probably would not have been able to be as resilient as we could have been as a business. So we have seen an improvement in our returns to shareholders with ROE progression of about 8.6 percentage points and an average capex intensity of 17.6% overall over the 5 years. With that, I will hand over to Ralph.
Tsulu, thanks very much. I trust that Tsulu has given you a flavor of what's detailed in our SENS and our annual financial statements in terms of the results, and I think you will agree that overall the results delivered were quite pleasing. Before we take Q&A, 2 more sections, one on strategy as we move towards 2030 and then priorities and outlook. We set out a strategy at the back end of 2019 going to 2020, looking at the structural growth opportunities that we saw, having looked and assessed where is the continent in terms of digital adoption, where is the African continent in terms of financial inclusion. And so that structural growth thesis has been the underpin for Ambition 2025. And as you see on the charts, some metrics that show you the kind of growth that we delivered. Subscribers, we're now at over 300. We started off, if we use rebase to the markets that we've exited some markets in the period, order of magnitude 10 million per year subscribers coming into the base, active data subscribers, more or less 12 million active net additions coming in who are regularly using data. And also we've seen, as I mentioned, good growth in terms of fintech, just shy of 70 million monthly active users there. Tulu has spoken about EEP, the progress that we've made. So we had two sets of EEP. We talk internally that expenses are like nails; they need trimming from time to time. So I anticipate that we'll have ongoing expense initiative programs. But during the period, quite pleased with the progress that we've made. And as Tulu has mentioned, the return progression has been pleasing. And our asset realization program, I mentioned earlier, we didn't execute on IHS for very good reasons, post their listing. And we've had a strategic pivot to bring back these towers. At the time we set out our strategy, some of you will remember that the valuation of IHS then was about 30 odd billion rand. From at least our share of that value was 30 billion rand at that time. And obviously with the market conditions and revision of strategy, we did not execute that. And then Nigeria, further sell down in Nigeria. Market conditions were not appropriate, 23, 24, and even 2025. We also assessed the situation with the changes in the tax code in Nigeria and decided that we wouldn't progress with a further sell down. Certainly at this stage, we feel that's the right strategy, and some of you have seen the Nigerian share price re-rate. I think probably the biggest job done is really the job to materially improve the quality of the balance sheet. We used to have 48% of the debt was hard currency. Almost 50% of our debt was hard currency, and we brought it down to 16, as well as the holdco leverage well below. So broadly, if you look at our strategic intent in terms of 2025, we can say when you look at it in the rounds, we've been able to deliver what we promised to our shareholders, and this year as we exit 2025, that you can see the quality of the results and the commercial execution therein. We still think that the themes of structural data and fintech inclusion underpin the future of MTN and the markets we operate in over the next 5 years. We started just at the end of COVID tracking these cohorts of data. What's data traffic? Because it's giving us a sense of demand. What's happening with fintech transaction volumes? Because it's also telling us a story about how customers are engaging with our services and new customers coming onto our platforms. In 2019, 282 petabytes in the network is now 2,234, almost an 8 times increase, showing you that there is structural demand and growth across our markets. Similar average transaction volumes per quarter, 1.3 billion, now it's just under 6, so that's like 4.5 times. So the thesis that says there is growth opportunities, the kind of growth that we delivered last year, the data showing us that remains on track. The group board spent quite a considerable amount of time last year doing a comprehensive review of the strategy and looking forward to the next 5 years to say how should we think about the strategy. I think a couple of key call-outs here. Firstly, the board endorsed the strategy as being the right one, and that the focus for us was to integrate certain pivots that we were seeing around customer behavior, use of technology, where is AI going, and related. But that the strategy remained the right one, and we needed to focus on executing with those pivots. They supported the point that there is an enduring investment case out there around digital and financial inclusion, and that we want to focus all our resources on the African continent. We are calling out a further simplification of the strategy in saying we're looking at it from 3 platforms. We're looking at connectivity across all our markets as a platform, as we are with fintech, and now increasingly looking also at digital infrastructure. And we'll be allocating capital across those businesses in line with the returns and the growth prospects that we'll see going forward. As I said, we are seeing our customers are increasingly wanting an appified experience. So you'll see that even in our CapEx, it will evolve where the share of CapEx in that 15 to 18 will be more IT than network to reflect the investment in much stronger customer experience. And as I mentioned, technologies such as AI are going to be with us, over the next 3 to 5 years as well. And that we need to have an operating model that enables us to capture these structural growth opportunities and deliver value. We're not doing it for the sake of doing it. We obviously want to deliver value for our stakeholders. We are framing, as I said, under the 3 pillars, but importantly, the purpose of the company remains the same. We're not changing anything there. Our purpose is really to deliver leading digital solutions for Africa's progress. We want to situate our own strategy into the progress of the nation states that we operate in. We think that that's a resilient and a sustainable approach on how to take forward our own strategy. So we're talking about platforms of choice for consumers, for homes and businesses. And under each of those platforms, we're calling out some very specific strategic priorities and where we are going to be deploying capital to invest. Scaling data for us is not just providing the raw data, but building the digital services that sit on top of connectivity. Currently our customers are doing about just over 12 gigs, data usage per month. And our customers are $2 to $3 average revenue per user. You go to India, same $2 to $3, 30 gigs. Why? Because there are services being offered that enable the customers not only to pay for the data, but the services that sit. So embedded in scale data is also our aspirations for digital services. Accelerating home, we think there is a significant opportunity in home over the next 5 years. A lot of the investment the last 3 decades has been about mobility. But over time, we think that homes is where a predominant amount of the workload. COVID was a bit of a wake-up call for all of us about networks and investments and the ability for our customers to be connected to the internet. And we see a material home opportunity of 20 to 30 million homes connected by MTN using different technologies, fixed wireless access, where we have the spectrum and the network capacity, and where we see the near-term opportunity to be deploying FTTH. So we are taking a technology-agnostic approach to connecting homes. The right technology that will generate the right economics is the technology. We're not particularly precious about a specific technology. It's the one that will give the customer the right experience and we're able to be able to monetize. We're also calling out enterprises for the next 3 to 5 years. The enterprise opportunity in South Africa is being meaningfully harvested. We still think there's some growth there. But on the rest of the continent, we still believe we are at right at the beginning. And we're not talking about the multinationals and large enterprises, but the small, medium enterprises who we can bring to them technology that enables them to be able to meet their own aspirations. Think of the ladies in the market when you travel to Ghana or Nigeria, selling tomatoes or clothes, whatever it may be, that gives them a sense of living. Technology on the phone should be a real enabler. That's a big opportunity that we want to tap into. Fintech, the strategy being clear, there is not something completely new. In fintech, it's really about executing the priorities that we've set around, about growing and expanding the ecosystem and accelerating the advanced services. On digital infrastructure, beyond fiber, we're calling out data centers. Our approach will be different. It will be one that's fit for purpose. It's not what you're seeing in the developed north or in China. But we think that with workloads that are coming out of our networks and our consumers, businesses that we operate, we need to be positioning ourselves quite thoughtfully around how we can deploy capital. And we put unlocked tower value because the IHS transaction is still subject to the various approvals. But if we get those approvals, it will fit in as that third box under digital infrastructure. all of these platforms really require across them, three key drivers. Customer experience, we think today, it's important to have a great network and great technologies, but the customer must experience, your service as leading. So we're talking about leading customer experience. We will leverage AI for growth. AI will evolve as electricity evolved after Michael Faraday, invented electricity. No one knew all the use cases. Our use cases will come, and we want to be positioned in a way that AI is enabling us to leapfrog, like mobile was a leapfrog for Africa from fixed lines. There is a potential here for a leapfrogging if we're smart and allocate our capital judiciously and smartly to the opportunities that come. And then obviously creating shared value. If you operate in Africa, you must be linked in deeply with the nation states that you operate in. And we think that the shared value framework is the one that will enable us to sustain and maintain our positions as being a partner of progress for all the nation states that we operate in. We're streamlining, next to the strategy, the capital allocation framework. I just got 4 pillars now. One which is really around the organic growth. We'll continue to invest sufficiently to have leading network and IT positions. So order of magnitude, think 15 to 18% of capex to sales is broadly, it's not a target, but just think of it as the way that we think about sustaining investment. The healthy financial profile, we want strong balance sheets. Strong balance sheets enable us to withstand shocks, but also to take advantage of opportunities as and when they come. We spoke to the shareholder remuneration framework, a framework going forward framed on equity-free cash flow, 40 to 60%, combination of cash dividends and buybacks done opportunistically. And we've been clear about the amount we spend on buybacks to the maximum over the next 3 years. And we do think value-creative inorganic opportunities will remain in our capital allocation framework. In the way we have assessed the IHS opportunity, it fits into that 4th bucket. It has to be value-creative, and it adds to a meaningful expansion of the investment case. So if you are to judge it, you need to judge it under that pillar 4. So this is the simplified capital allocation framework that we'll use to discipline ourselves in how we deploy capital across the businesses. We think the investment case substantially remains the same, which is there are structural growth opportunities across our markets. We as MTN uniquely positioned with the scale that we have, the assets that we have. And Sulu took you through the financial framework for generating value, and we're adding to it this shareholder, a compelling shareholder remuneration framework, to thank the shareholders, for deploying capital. We think that becomes a really important part of our financial framework. And as I said, creating shared value remains the underpin of how we lock ourselves in with the nation states that we operate in. So we will have an opportunity. I think in or around the 10th of June, we're having a Capital Markets Day. It will be held here. I think you should anticipate the invites where we will delve into all of these areas in a lot more details and give you the confidence we have about our ability to execute the strategy and deliver value over the next 3 to 5 years. So just a few points on outlook and priorities, and just starting with the outlook. We had a very benign macro relatively last year, but I think as we've started this year, there is obviously a lot of global uncertainties. There's conflicts in the Middle East, the European conflict in Ukraine, and Russia is ongoing. There are conflicts on the African continent as we speak today, whether it's in Sudan or other areas. So we're alive to these macro conditions and how we need to manage and operate in them. More recently, obviously, we've seen quite a lot of volatility around oil prices, as well as all the issues that you are all familiar with regards to what are the second order effects of some of the conflict in the Middle East and energy prices in particular. We also remain focused on managing kind of an evolving regulatory environment. We operate in multiple countries. The regulatory context is not the same across all of the markets. So we have to, remain, nimble across the evolving in terms of regulatory context. And with such a macro backdrop, how are we thinking about the year ahead? And I'd like to make 5 key call-outs. The first is maintaining resilience in this global macro. And what does this specifically mean for us at MTN? The balance sheet, ensuring balance sheet strength and resilience. The choices we make about capital allocation expenditure, we'll always keep an eye on how do we remain resilient with the balance sheet. Supply chains, we understand as this big build out of AI, chipsets are in short supply or getting more expensive. We are spending time thinking about the supply chain, which components of technology are critical, and what the choices and the trade-offs we need to make in terms of meeting our supply chain needs within the context of a finite investment that we can afford. And as I said, we'll continue to look at the expenditure. So maintaining the resilience that we've shown over time during this period will be key. The second is sustaining the commercial momentum across our markets that we've seen. And as Tulu has said, sometimes we have internal markets that we say close monitoring, we need to improve. So a market like Zambia jumped out of close monitoring. We're seeing Cote d'Ivoire showing good gains. Cameroon is growing. We want all our markets to be contributing to the overall results. There are several countries outside of Nigeria, South Africa, and Ghana, and those have to, deliver results in line with group expectations. So we're calling out a sustaining. South Africa, as I mentioned, big priority around the SA prepaid. It's 52% of service revenue. We have to get that into growth to be within our guidance range for service revenue and EBITDA margins. So that remains focus. Fintech, it's a story of execution against commercial and strategic objectives. We're not debating strategy. We are focused on the execution side. And then finally, completing the IHS transaction. That is obviously subject to shareholder approvals and getting through all the regulatory approvals. We've commenced, engagements around some of the regulatory approvals to soft sound and engage with, the third-party customers of IHS, but obviously the formal engagements with authorities, both regulatory and shareholders, and we anticipate that general meeting will probably be called by IHS in May to get through the shareholder vote. We had also anticipated that today we'll be sharing with you the pro forma effects of our results and IHS. I think IHS just released results now. So once we have their results, soon as practically possible, we will share those pro forma effects. We won't wait until Q1 trading update. As soon as we've done the work, kind of out of cycle, we'll be able to share what those pro forma effects. As we said, we believe that the deal is value accretive, also at earnings and cash flow level, and we remain convinced of that. But we must put that in a form that you can all consume and be equally convinced as we are that this is a deal that fits into Ambition 2030 and will ultimately deliver value. Finally, medium-term guidance, as I mentioned, much of it remains the same. We didn't want to change too many things, so you can see there that the guidance is largely the same. What have we changed? Returns, ROE, now to return on capital employed. And we feel that that is a better measure. And even our LTI going forward will have an ROCE ex-ante measure that you'll see, you'll see in due course. So that's ensuring that what we say to you and as executive team, that we have meaningful amounts of the LTIs focused on delivering returns and ensuring the returns above the cost of capital. We're also focusing on net debt to EBITDA now, just again to simplify. And even with the IHS transaction, remember that the debt is not at the holdco. It will be in a subsidiary once we conclude. So that's actually a more meaningful measure of where we'll be, and we're calling out that we want to be less than 1 times. We are at 0.3 times at the moment, but we believe that given our profile and the markets we operate in, we want to be judicious and remain below the 1 times for leverage. Ladies and gentlemen, thank you for spending almost just over an hour listening from Tsulu and I think it was a little bit more extended because we wanted to talk about strategy. Thank you.